Hello everyone, this is Mark with Semantics Trading with your daily report. So today we've seen some rather balanced action in the markets as the S&P failed to gain any traction above the previous session's highs, as well as failing to break the lows of the day. So we have seen stocks rising recently due to discretionary players betting on the Fed cycle ending, despite the Fed saying that they are committed to dealing with inflation. So let's see who is correct. The TIPS yield is coming down, which raises the equity risk premium as well for stocks, and that also boosts inflows into equities as it makes bonds a less competitive investment to equities. Now, if we take a look at this chart, we see that we haven't been seeing hedge funds chase a rally as buying and leverage changes have been somewhat limited. The net flows are paired off at the moment, and we do see some short covering, but it's not something that we would consider extreme, as among equity long short funds, the short leverage is at the 88th percentile since 2017. Some discretionary funds have captured the move up, but it seems like multi-strategy and equity quant funds appear to be flat or down slightly. And there is an expectation for systematic macro strategies such as vol target, CTAs, and risk parity to be net buyers of equities about 10 to 15 billion in a near term. We do see that vol control funds have modestly raised their exposure to 51%, which is quite minimal historically speaking. So there is plenty of room to expand if the right conditions occur. CTAs and risk parity funds are still quite low weight. And another positive thing that may play into the bull's favor is buybacks, which are set to pick up after a blackout period, and any potential month-end equity supply from pensions is now in the past, as rebalancing is pretty much finished. The PMI is showing that new orders continue to do a downward slide. We do see inventories at its highest since 1984, which is showing demand destruction. A big drop in prices paid by purchasing managers does help the inflation issues, but the latest data point basically shows that the Fed's aggressive tightening cycle is beginning to take effect on the economy by slowing down economic growth, as shown by the Purchasing Managers Index for manufacturing. Staples outperformed today, with energy being the biggest loser, which reflects a growth fear in the market. And we also do see geopolitical tensions keeping the market on edge, as China is threatening to use its military force if House Speaker Pelosi makes a historic visit to Taiwan. Following the report, the offshore renminbi fell about 0.6% on the day, while non-deliverable forwards on Taiwanese dollar indicated a weakening of the island's currency. If you take a look at the 10-year TIPS yield, we do see that it has come down quite a bit, and that is quite bullish for stocks. And if it were to keep routing and keep falling, this should increase equity risk premium, because that means that the yields are coming lower than inflation. So investing in stocks are preferred over the bonds, because it makes bonds less competitive to equity markets, and it does lower treasury yields attractiveness compared to stocks. And essentially, when inflation is much, much higher than treasury yields, the less attractive bonds become, and the wider the spread becomes between the inflation rate and the treasury yields, the less attractive or the less likely people are to invest in, the less demand there is for bonds. And looking at Black Sea, import dependency chart, we do see that Russia and Ukraine are very important regions for the global wheat supply, especially for many very hot geopolitical hotspots. And we also did see that Moscow and Kiev came to an agreement where they are shipping out grain supply again, which the first shipment has gone out recently, which caused grain futures to come down quite a bit today. And we do see with the S&P Global manufacturing PMIs, we do see a global growth come to a slowdown, which is expected, of course. And with that being said, that is it for today's recap. I want to thank you all for watching. And if you did like the video, do subscribe and be sure to check us out on social media and as well as our Discord. This is Mark signing out.